Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, July 10th, just after the close. What do we see this week? What have we been talking about for the last 3-4, let's call it 4.5 weeks, back to June 10th, almost a full exact month ago, when the S&P on the 9th and 10th hit that intraday rally that we've been seeing since those March lows. We spoke about the market correcting through either price or time, or a combination of both. What we've started to see here is it looks like the correction through time is winning out. We had 5.5% pullback in the S&P. We spoke about that demand at 29.50, 29.75. Well, late June we cracked 3,000 early in a session. Plenty of demand at 29.95, driven the market back up. Still the same cast of characters. NASDAQ 100, software, semiconductor, that bid just pounding. It was nice to see today a couple of the sectors that have really been hit with supply start to come around, and that's banks, energy, industrials. Basic materials to a lesser extent. They've held in there. Let's concentrate on banks for 30 seconds. I keep JP Morgan as a big bank and PNC Bank as a regional on my screen at all times. For me, those are my go-to securities when I want to try to test the banks, see how they're trading, see what the bid, see what the offer looks like. These two names have been driven down now to an area that historically has been a nice buying spot, and that is when you get to that 4.25% dividend yield versus a 65 basis point 10-year. That's blown out diversion in terms of income. Now, what's the question with banks? The question is growth. Where are they going to get growth going forward at a 65 basis point tight spread business? We have to lean on a recovery in the economy, and the fact that these banks, year after year, have been going more and more to fee income versus that spread business. So those are two names that are large pieces within the regional bank ETF and the big bank ETF. We are long banks, so I'm talking our book here. We like them here. They have had an awful 4-week run, yet where they turned today would create a higher low versus May. Important from a big picture to look at that. Supply and demand. Higher lows mean less selling, more buying at a specific price than 2 months ago. Let's see how they trade going into next week. Energy, another area. We're not long your traditional oil and oil service names because we have trouble making a balance sheet guess or analysis there. So in terms of beaten down sectors, we'll stick to banks and financials versus energy here. Because what we're trying to figure out day to day, week to week, is if money starts to come out of the high growth names, if some profit taking does start to appear, where does it flow? So we talked about a couple areas that have been beaten down. What about the flow back into international? We spoke at the end of last year about the reallocation, record reallocation out of international into domestic. And listen, that's been the right trade for a decade. You look at ACWX, All Country World Index, ex-US, and EEM, MSCI's index of emerging market countries. They're trading where they traded 2007, 2008. Now, we've discussed this before. Each time they've worked their way through this, ACWX trades as an ETF. Each time it's traded through this 45, 46 area, boom, supply comes in, knocks it back down. EEM, same story. It's had little runs through these 2007, 2008 levels, only to get knocked back down. But maybe this time is different due to the global monetary easing. Does that support create an opportunity where there's a decent risk reward in these areas for, the first time in a decade. Let's keep open-minded. Let's keep flexible. When we get dogmatic on thinking, domestic only, growth only, we're normally going to find ourselves behind the trade. We use relative strength for a lot of work, and right now, that relative strength in large growth is solid as a rock. But we need to be aware that markets can change, and we'll keep an eye on whether some of this value, which only popped today after, as I said, a really weak 1 month run. Let's see what it does next week, if it can start to eat in on a relative strength score to any of these large cap names. I have some special news for you. There's been an unusual moose spotting in Rhode Island. So stay tuned for the moose. He has some great comments on bonds. Have a great weekend.
Hi, it's John Mousseau. I am the President and CEO of Cumberland Advisors and Director of Fixed Income. It's Friday afternoon, July 10th. This week, Treasury yields lower. 10-year yields down to about 0.61. They briefly pierced 0.6. They're down about 7 or 8 basis points. Long Treasuries down to about a 130 from a 144. They also pierced 130. Why did this happen? This was fear of spreading of the pandemic. Especially in the states like Florida, Texas, we expect to probably see it coalesce around here, just like we were a few months ago. The key to this will be that these new cases start to decrease and that the amount of new cases increase at a decreasing rate. That should start to bring some return to normalcy to the bond market. On the muni side, you saw yields also come down maybe half as much as Treasuries, so munis still remain cheap to Treasuries, but at nominal, almost all-time lows, because you're almost back to where you were. You are back to where you were at the end of February. Give you an example. University of California brings a large $2 billion deal to market this week with taxable and tax-free bonds. The long end of the market was 2.5% at par, so really almost twice as cheap as Treasuries, a little less so. Good demand, but think about it. For a university which clearly has challenges as you go into the fall, still lots of demands for the bonds. Now, why was that? One, because Cal is a very well-known name. Two, as a state university, they have more flexibility than a lot of smaller colleges in how they deal with these issues, and these are still being worked out. We're seeing that on the athletic front as we sit here. We saw the Ivy League cancel their fall seasons. We saw the Big Ten say they will play football at this point, but only with fellow schools in the Big Ten. So you're going to see this hunt and peck approach by universities, and it's by no means etched in cement as we go forward. But I think from the bond perspective, the real key to this is the fact that there is plenty of demand for tax-free bonds of high-grade quality, which University of California is. This is a holiday week. It was very short in terms of amount of issuance coming. We expect to see that pick up as we go through the rest of this summer, and that would be starting next week when you're seeing some very large deals on the calendar. Some important statistics for next week. We saw PPI come down this week, negative numbers. That's to be expected given what we've gone through with the pandemic. Next week is CPI. We expect to see those numbers come down. We do expect these numbers to flatten out though, and we don't expect deflation. And part of that is the really tremendous amount of support that we've seen from the Federal Reserve, the Treasury, and the federal government. So with the amount of stimulus through either PPP loans, the amount of unemployment that insurance has been out there and provided to individuals, we'll see whether they extend that beyond the July 31st end date. All of this has really propped up the consumer. So we don't expect to see CPI go tumbling from here into truly negative territory. We expect to see it plateau. And quite frankly, as you get into next year, you might even see inflation start to pick up a little bit. mainly because of all the government programs that are out there. So, a week where we saw yields decline a little bit, concern over the pandemic. We're watching the pandemic to see whether the amount of new cases start to flatten out, just like we did earlier this spring. And we expect to see more supply in the muni market as you go into the next part of the summer. We hope you all have a great weekend. Thanks a lot.